What's going on, guys? Matthew Minnis here. Welcome back to the channel. Today we're going to discuss one of my favorite topics, dividend ETFs, and also, according to YouTube analytics, one of your favorite topics. Now, more specifically, we're going to talk about the Enhanced Dividend Income ETF DIVO. This is similar to some covered call ETFs, similar to some dividend ETFs, and it's actually a hybrid. It does a little bit of both, which is awesome. Now, before we get into the video, I do have to disclose that I am not a financial advisor. I just invest as a hobby. I enjoy putting out my opinion, and it's up to you guys to make your own financial decisions. And the last thing to note is that I do actually invest in DIVO, so technically my opinion could be biased, but I'm not telling you to make any purchases and I'm not telling you to make any moves. So let's get right into the video now. So what exactly is DIVO? Well, Amplify ETFs came out with DIVO back in December of 2016. Now, it's about 5 years old, and DIVO is actively managed by a company called Capital Wealth Planning. DIVO has some interesting strategies or different pieces of it that I particularly like, so we're going to go over that now. DIVO has an expense ratio of 0.55%, which is a little bit lower than the traditional covered call ETFs that everyone discusses, Q yield, R yield. It has around 20 to 25 holdings, and those holdings are generally high quality large cap companies that have shown in their history that they grow their dividends and they grow their earnings. They don't need to be dividend aristocrats with a 25 years of continuous growth, but they do need to be showing strong growth over time. So the great thing about DIVO is that it pays out monthly income from dividend paying stocks that it holds, and also it strategically writes covered calls on some of the stocks. Not on all of them, not on the entire index, like some of our other covered call ETFs. All right, so you may be wondering, why is this important? Why does it matter that they don't sell covered calls on all of the holdings? So when you write covered calls on all of the assets, you're essentially capping the growth of the fund. You're not allowing for there to be any type of capital appreciation. Now with this fund, because they only do some covered calls, you still have all of the holdings that don't have any options assigned to them. Those holdings can still grow and you're participating in the market's growth or decline. What CWP tries to do is through active management, they choose specific stocks that they think can generate some high option premium that will be above average returns, and they try to capitalize on that. So with DIVO, you're still able to receive capital appreciation, and we're gonna go over some charts that show that, but you also receive the monthly income from the options premium, and then on top of that, you're still getting the dividend income from the holdings as well. So really, with something like DIVO, it's 3 separate ways for you to build your own wealth. So really, you could seek to replicate this strategy yourself. However, that's the reason you have an expense ratio. You're paying for someone to do all that work for you. So for someone like me, I don't really have time to do all that research. You know, I work 9 to 5, I have a kid, I have a wife. I don't have enough time to do all that, so I invest in ETFs or actively manage ETFs for specific scenarios like this, where I want to capitalize on monthly pay coming to me, and I also still want to have growth in my portfolio. If I just invested 100% in something like R yield, for instance, then over time, my nest egg could actually decrease if I was spending all of the dividends. With this, I could spend all the dividends and I could still be growing my nest egg theoretically. All right, so now that we're done talking about theory, let's look at the actual past results. One thing to remember is that past results do not guarantee future results. However, you can use them to find trends and then forecast out potential future results. So since inception, back at the end of 2016, we've gone from a $25 price point up to a $36 price point today on September 15th. This shows that even with the monthly income, which is around 5% annualized, you still are showing capital appreciation on a year-over-year basis. Now, we did have the massive crash back in March of 2020, which we saw across all markets, but then we saw a healthy recovery, which was largely a result of government intervention and stimulus. And then you see it to continue to grow and rise steadily after that. Now, when we look at total returns annualized, we can see since inception, we averaged around 14.5% per year. When we compare that to the S&P 500 in that same timeline, we have a 17.25%, which is higher. And what you're going to find is most of the time, if you just invest in the S&P 500 over a long period of time, you're going to have better results than specific ETFs or specific stocks. Now, you may get lucky and you may have invested in Dogecoin and sold back when it was 69 cents. But most of us aren't that lucky. And if we just follow the standard rule of time in the market beats timing the market, it's almost better than buying and selling at specific times, specific securities, and hoping to beat the general market. Just remember that when you're investing in monthly income ETFs, most of the time you're not going to actually beat the general market. You know, if you invested in the NASDAQ, you'd probably have higher overall returns, but you're going to have more volatility. And with monthly income, it makes it easier for people that are looking for just a monthly paycheck that they can rely on, or they can reinvest. Sometimes mentally, it helps you be more consistent with your investing when you see monthly paychecks coming back every single month, and it's up to you if you want to reinvest it or spend it on whatever you like. So now we need to talk about taxes. I'm no tax professional, but when it comes to this ETF, it's similar to others where for the options, generally there is some return of capital, and then you're also going to have short-term capital gains, long-term capital gains, and some qualified dividends. If we just go to the most recent tax form, we see that year to date, they've distributed 73% of their returns have been return of capital. In the previous month, it was only 61%, and 27% has been actual investment income, so taxed as long-term or short-term capital gains. So, all in all, what do I think of DIVO? Well, I actually really like DIVO, and there's a few reasons for that. One, love monthly income. Two, I like the opportunity for capital appreciation. Three, I love the extra income from options premium. Four, ever since I started investing, dividend investing has been my particular strategy and the one I believe in the most. Just makes it easy for me, and that's what I like. And five, the other thing I want to draw attention to is with covered call ETFs specifically, so even though it's only a small portion of DIVO, I do want to bring light to this. Some people think that you shouldn't be investing in these unless you're going to retire soon or you're already in retirement. Now, when you're in retirement, monthly paying, high income covered call ETFs are a great source of income for someone like that. However, even as a younger individual, you can still invest in these things. It just depends on what you're trying to do. So if your goal is to have the highest return over a long period of time, then yeah, you might not want to invest in that. However, if your goal is to supplement your traditional 9-to-5 income on a monthly basis, and you have, we'll say $25,000 in the bank, well, you could just take your $25,000, put your money in Q yield, and you could collect around 1% a month. So $250 a month that you can use towards whatever you want. Maybe you go on vacation once a year and it costs you around $2,000. So every single time you get a paycheck from one of your income ETFs, you put it into your savings account, and then you go on vacation, you have $500 left over. There's absolutely nothing wrong with having a strategy like that. That's something that I do particularly, and it works out great. Maybe you want to use your monthly income for a new car. If you want to do that, that's great. Whatever you want to do. Now, that being said, you do need to balance everything. You need to make sure that you diversify your portfolio. You don't want to put all of your money into Q yield. So a good option is maybe have a dividend ETF, a strong one over here, like SCHD, and then you have your Q yield here. If you combine the two, your covered call ETF and your dividend ETF, all of a sudden you have something that's very similar to DIVO. Now, maybe it'd be a little closer to X yield because it goes off the S&P 500, but not a big deal. So if you've watched this entire video, comment down below, let me know. Hopefully my scratchy voice didn't bother you too much. I still don't have my normal voice. I'm not sure what's going on, but I feel 100%, so I guess that's good. Either way, hit a like, come back next week. If you're not subscribed to the channel, make sure you're subscribed. We do videos every single Thursday at 3:15 p.m. Eastern time. Thanks, and I'll catch you in the next one.